The very first step of purchasing a home with a mortgage is working with me to determine whether or not you can afford it. This process is known as a pre-approval, and it's comprised of three things: a verification of income, assets, credit, and debt. So let's start with income. Underwriting guidelines emphasize consistent, reliable sources of income. In most cases, we're going to need to see a 2-year history of documentable income. There are exceptions to that. Rule 1 being is if you are a recent college graduate, we can use education as work history, and we'll just need to see 30 days of pay stubs on the new job to qualify you. Assets, as we define them, are the total amount of funds required to close this transaction. Where are these funds coming from? A checking account, a savings account, a 401k? Is it a gift from a family member? And the source of these funds is going to determine the documentation that we're going to need to collect from the borrower. Credit, or what everyone knows as a credit score, is a reflection of your ability to pay back debt. While debt, as it's seen in the qualifying process, is your minimum monthly debt obligation. So debt, as we consider it, is the minimum payment and not the full balance. What we're not going to see in your credit report, and it's very important that you disclose, are things like alimony, child support, or IRS repayment plans. Your pre-approval is going to give you a clear picture of your financial position, which is going to give you confidence when you're out there making offers. You're going to know exactly how much you qualify for, the loan programs you qualify for, your monthly payment, and the funds required to close a transaction. I tell people, let me help you with your financial picture as it relates to your purchase of a new home. You can call me, text me, email me anytime.